ETFs or exchange-traded funds are often designed to track the performance of an index. Think the FTSE 100 index here in the UK, or in the US, the S&P 500 index and Nasdaq 100 index. These indices can include hundreds of companies, and ETFs give you a simple way to invest in them all at once. But how do ETFs actually manage to track an index? In this video, we'll break down everything you need to know, from physical replication to synthetic or swap-based, and even how ETFs track commodities like gold. By the end of this video, we hope you'll understand the main techniques ETF providers use and what that could mean for your investments. The ETP family includes ETFs, ETNs, or exchange-traded notes, and ETCs, exchange-traded commodities. ETCs track the performance of physical commodities like gold or silver. But for most investors, ETFs are synonymous with index tracking. They aim to deliver the same returns as a particular index by replicating it as closely as possible. And there are different ways of doing that, depending on the index being tracked and the strategy of the provider. One of the most common approaches is called physical replication. A physically replicated ETF typically buys and holds the shares or bonds that make up the index. If you invest in an ETF tracking the FTSE 100 index, for example, the fund will own shares in the companies in the FTSE 100 index. When those companies go up and down in value, the ETF should move in line. Now, with physical replication, there are two methods: full replication and sampling. Full replication means the ETF owns every company in the index in exactly the same allocation. This approach can work well when the index is relatively small in constituents, like the FTSE 100 index. Sampling replication is different. Instead of holding every single company, the ETF buys a representative selection. This is used when the index is very large or includes illiquid securities, like global bond indices, which may have thousands of different bonds. Sampling makes it easier and more cost-effective to replicate the performance, while still keeping the tracking of the index accurate. Another method is swap-based replication. Instead of holding all of the companies directly, the ETF uses a financial contract known as a swap. Here's how it works. The ETF provider partners with banks who act as counterparties. The ETF might hold a different basket of companies, not those in the actual index. Through the swap contract, the bank agrees to pay the ETF the performance of the target index, and in return, the ETF pays the bank the returns of those shares that it holds. In other words, the swap contract swaps the performance of one basket of assets for another. The result is that the ETF tracks the index, even though it doesn't directly own all of the underlying securities. Swap-based replication can be useful in markets where physical replication is difficult or expensive, such as emerging markets or niche strategies. But it also introduces counterparty risk, the risk that banks on the other side of the swap contract could fail. That's why swap-based ETFs are carefully structured with safeguards, and providers like Invesco work with multiple counterparties to reduce that risk. ETPs don't only track equity and bond indices. They can also give you exposure to physical commodities like gold and silver. In these cases, the ETC may actually be backed by stores of the metal in secure vaults. For example, each share represents a portion of that physical gold or silver, so the ETC price moves in line with the spot price or current market value of the commodity. Some commodity ETPs, however, use futures contracts instead of physical storage. Futures are agreements to buy or sell a commodity at a set price on a future date, and they allow the ETC to mirror price changes without needing to hold tons of metal. So whether it's bars of gold in a vault or rolling futures contracts, commodity ETPs provide a way for investors to track the price of raw materials just as easily as they track stock market indices. So, whether through physical replication, swaps, or even holding gold bars in a vault, ETPs use a wide range of tools to track the performance of their chosen index or asset. That flexibility is what makes ETFs and ETCs versatile building blocks for investors. They can provide access to everything from large companies to emerging markets to precious metals. At Invesco, we provide a wide range of ETFs designed to help UK investors access indices like the S&P 500 index and NASDAQ 100 index efficiently, confidently, and in a way that suits their goals. To get started, explore Invesco ETFs on Invest Engine and see how easy it is to bring commodities into your portfolio.